Hi, everyone. I'm here with Justin Freishtat. He spent the first decade of his professional career building Heartland Foods, which was acquired by a private equity firm in early 2022 after the company had generated 87 million in lifetime revenue. Now, Justin is the founder, president, and CFO of Alpha Tactical Partners and managing partner at Kearns Capital. These firms manage various hedge funds in private equity and equities trading. Justin also helps individuals and businesses build and monetize their brands on social media as vice president at Kearns Marketing. It's good to have you on, Justin.
Yeah, it's great to be here. I'm excited to dive into this.
So thanks for coming on to lend your expertise. Not everybody that listens to the show obviously is a big hedge funds guy or understands capital formation as well as you do. So maybe you can explain it like I'm five. Tell me a little bit about what you're seeing out there in terms of modern private equity. What's going on right now in terms of capitalizing the fund structures you're seeing, and what kind of investor strategies that have changed now in the last little bit.
Yeah, from a basic high level, a fund, a syndication, these are all fancy terminologies of essentially putting together a partnership, a legal entity where you can bring in limited partner capital. Limited partner means somebody who's investing in the partnership with a limited role. And then you have the general partners who are actually facilitating the investment, managing the partnership. So that's really all it is. And there's a ton of different ways to form funds. You can do SPVs, which are special purpose vehicles. In real estate, they call them syndications. It's essentially where you're buying one singular asset, whether that be a private equity stake in a company or a piece of real estate, and you're raising capital into that one deal, and then the fund is closed. Then there's continuous funds where we can call them evergreen, where you're always raising, always distributing. There's debt fund structures where you're paying out a fixed payment in terms of debt versus those partners taking on an equity piece. So there's a lot of ways to structure all this stuff. And legally, there's if you're only going to work with accredited investors, you would be in a 506C is what that structure is called. And then a 506B would be you can raise from unaccredited, but you have to have a prior relationship with those people. So depending on what type of partnership you're putting together and who the partners are going to be, there's a lot of different ways to structure all of this.
So that's something you've really taken on the last little while, I guess, and you've gotten into this, creating a fund and so on. And I know you're thinking of launching this new one soon, right? That's going to be happening. Can you tell us a little bit about that?
Yeah, the new fund's ready to go. All the documents are done. The partnership's been formed. All the relationships are being put in place. So in terms of you have to have fund legal, you don't have to have a third party administrator, but I highly recommend it. You need an auditor, you need fund banking. And then if you're going to be trading, which this is a trading fund, you have to have a prime brokerage as well. So we're about 15 days from being up in trading. So I'm really excited to get the new fund launched here.
So what sort of created the idea for this in terms of the structure that you wanted to create, and especially having like the third party auditor you were mentioning? Not everyone is doing that, right?
Yeah, I know this is something we're going to talk about more at length, but third-party administration, if you're looking at investing into a fund or any private placement offering for that matter, to me, it's the most important thing as a limited partner that I would want to see in terms of due diligence because it just protects everyone in the partnership. It protects the limited partners, it protects the general partners from themselves, and it just puts a layer of checks and balances and trust in place when your statements are coming from a third party, the funds being, has oversight essentially, is what that is. Versus if, a lot of people are just doing deals on their own, they're doing their own accounting, they're sending out their own statements. No matter how much you trust someone, at the end of the day, you're taking their word for it in that scenario. So I think third party admin's just a must for me.
So, I mean, obviously the market's kind of changed. And I guess the big shift that I would see was the Silicon Bank fiasco, let's say, that happened quite recently. And from what I've seen on the VC side and so on, a lot of companies or a lot of groups, they just haven't written checks in years. It's been maybe a lack of good opportunities or AI sucking all the money out of the whole system. But what are you seeing out there?
Just a ton of headwinds in general. I mean, once the Fed started raising rates, you saw the cost of capital go up. A lot of deals, especially in real estate, that were underwritten on low interest rates with high asset values are really struggling. So you have a ton of VCs, high net worth limited partners that have a ton of capital that's either tied up or in a lot of scenarios, complete loss of equity, which I've seen in some of the deals I'm in that are really struggling, particularly in real estate. Same thing with the VC world. I think it's a lot of wait and see right now. And when the cost to borrow money and deploy it goes up, you become more selective with how you use your dollars. Back, 2020 to 2022, when Fed rates are at zero, you could borrow against your assets at a couple points and then go deploy it and just arbitrage that. That's much more difficult to do with rates, where they are today. So I think there's just a lot of constraint that's causing people to pull back, and especially limited partners are very nervous to redeploy capital. There were there was a 40% increase from 2019 to 2022 in the amount of households in the US that qualify as accredited investors. So you had a huge cohort of new people that had high net worth that deployed capital for the first time into a very frothy environment, and their first experiences were not very good. So people are very gun shy to redeploy and invest in really anything right now.
So how do you go about fundraising? Because that's obviously something you're going to be doing soon, right? In this kind of environment, like transparency, I think is a big part of that, and name recognition, right?
Yeah, it's the old Warren Buffett thing, right? Be greedy when others are fearful, and be fearful when others are greedy. Now, when everybody's gun shy, this is when all the best opportunities are going to be there. So, and you have to look across different asset classes. I think real estate is about to be a great place to be. There's certainly great deals right now. But to your point on the Silicon Valley Bank issue, we also have a lot of private credit problems right now. A lot of debt that's upside down. I mean, I'm in a deal. I'm in a limited partner in a deal in Atlanta, about 300 unit apartment complex that's only worth 55 million right now, and we owe 75 million on that property. There's a lot of deals like that are upside down because from when we bought them at low interest rates, if you were on a construction loan, adjustable or bridge debt, all these deals have blown up. The insurance cost has gone up. There's just so many things that have happened. So it's a tough environment, but it just means that, when things get constrained, you just have to do more of it, right? So my first time raising capital, my first fund was in that frothy time. And I raised 10 million bucks my first year doing it just off of organic social media podcasts. That environment's completely switched. So you have to just do more of it. We're looking at different ways to do marketing, meta ads to connect with more accredited and qualified clients. So that's another thing about who can invest in your deals. For me, with the new hedge fund, because we take performance fees off of trading, any limited partner that comes in has to be what's called a qualified client. So they have to have, it's a layer above what is considered an accredited investor. So they're going to have a 2.2 million net worth or deploy 1.1 million or more into the deal. So you just have to know who is your pool of investors, the cohort that can come into your partnership, and then you just go find them in the marketplace. I mean, a lot of raising capital is just networking, getting in the right rooms, building relationships, nurturing them over time. And you can also, do paid marketing efforts. I've done everything from speaking on stages to sponsoring events. That's how you're going to find your investors until you're big enough where you can get family office and institutional capital.
Yeah, I mean, I've definitely heard about the family office thing and dealt with quite a few family offices. And I guess the fear of the market lately is just the volatility we've seen out there. It's been very volatile. You don't know what's going to happen in the news cycle. It can affect things so much, from energy to all sorts of other things, like tariffs, for example. With investors, I mean, I guess when you're trying to find these qualified investors or limited partners that you want to join up, in a large part lately, the whole VC space has become a lot commoditized, right? And so building a personal brand, getting people to know you, that's sort of like table stakes now in building a fund, right? That's something you've done very well with building your social media presence and content and getting out there, right? What is would you say that all VCs need to be doing this now if they're looking to do any kind of business going forward? Or
I think it really depends what level you're playing at. If you're well established and you're at the institutional level, you really don't need it. I see, because we also do late stage private equity, where I see the biggest checks being written. In some of these groups I'm in, I see blocks of Anthropic, SpaceX moving at, to the tune of one investor or one, broker dealer facilitating, $100 million block. And so those are always going to move. Those are done at high level relationships. Those people, you won't see them on social media at the highest level. But if you're on the lower end of this thing and you're trying to build something new, depending on how much capital you have to invest in yourself and building it, I don't think there's any better path to do that than building a personal brand. And it's kind of bigger than that. It's something you're going to build one time that's going to be the greatest networking tool that exists in today's world that you can go do anything with, right? So it's not just, I use it to connect with people I partner with. I use it to meet accredited investors that, like I can do business with, but it's also who's my favorite artist and I want to go backstage at their show. Like I can send them a DM and they're going to answer. So it's stuff like that. I think building a personal brand is just the most valuable thing you'll ever do.
Yeah, I mean, I think across all business and leadership, we're seeing people finally getting, aware that need to have a presence of some kind, right? So it's not for everybody, of course. Not everybody likes being a content creator or influencer, as you'd say, but it's definitely becoming more important. And especially in recruitment as well, we're seeing that as, like, for example, you're hiring sales reps, you need them to have a social presence because social selling is a big part now too, right? Regardless of the industry. So can totally agree with you on that. What are you seeing there in terms of, like, there's the volatility that's going on. Then all these investors, let's say the retail investors, are looking for ideas and people that they can trust to invest in. Do you see that retail investment becoming more of a social media thing than going to a financial advisor at the bank and just plugging away? Like what do you see as a shift in terms of, like, people's willingness to invest in people rather than institutions, right?
Yeah, it's a very interesting environment. I think a lot of people want to be investors in the age of YouTube and all these things where you can do research. It puts more everyday accredited, middle of the road, high net worth people in the market to either invest in early stage companies, late stage, hedge funds, real estate, oil and gas. Like now there's more people than ever, more funds being launched than ever, and people are putting it on social media. So the exposure to this world is becoming much more mainstream, whereas it was a very behind the scenes thing, very hard to get into previously. And the problem with that is now you have a lot of inexperienced people, and you have marketers that aren't great operators with track records that are raising capital from people. I see a lot of less than ethical things going on. People not putting money into their own deal, raising it all, taking an acquisition fee and just hoping for the best and not really caring about the quality of the deal. And then all those limited partners coming in, they just don't have the expertise to do the due diligence. And they're looking at slide decks and projections, which it's just, you have to be so careful because people will look at a slide deck of multiple deals and they're like, well, I might go into this one, but that one's only an 18% preferred return or internal rate of return. And this one's projecting 22. And they'll just go with whatever's better on the slide deck. And at the end of the day, this is just a projection. So you got to really, really do due diligence. I think meet with a lot of fund managers and really ask them, how would you do due diligence on a deal? I mean, that's how I raise capital. When someone comes to a call, I want to know what their level of experience is. I want to let them know, like, whether you invest with me or someone else, this is what you should know and what you should be looking for when you vet people.
Well, do you think there's a bit of a competition with, like, not to say gambling, but like poly market, and like it seems like there's a lot of new avenues to throw money around, and people are kind of like, there's a lot of wishful thinking too in some cases, right? With online gambling is a big thing now, and crypto, I would say, is almost like gambling in some sense, because I've seen stocks and, not stocks, but crypto coins zero out overnight, like Solana, and some it's just like, well, I'm hoping you didn't have your mortgage in there, your mortgage payment or something. It's become very sort of casino-ish, and I guess what you're saying is having some actual fundamentals behind what you're selling is important, because there's the low information investor or gambler, I would say, that's out there just throwing money around based on what they think is good or what's good on a slide deck. But once people actually take time to research, then that's where you need to have, like, some good fundamentals, good background, good accountability built in to what you're doing.
Absolutely. I think the number one question you should ask yourself whenever you're going to deploy money is, what is the strategic advantage I have in this deployment that no one else has, right? If so, for instance, that's why I just don't buy crypto. Not that Crypto's a great investment if you bought it and then sold it higher, right? It's a terrible investment if you bought it high and sold it lower. Like that's all investments. So we can't asset discriminate. We have to ask ourselves, am I getting a legitimate discount to market value? Is there a competitive advantage here that I have over someone else? So for instance, I don't want to buy Bitcoin at the spot price because anybody can go buy it at that price right now. I didn't get a good deal on it. I got a fair market deal. As an investor privately, if I can get in on a mining deal where I'm getting Bitcoin at a discount, now I have a built-in spread of profit. That's a competitive advantage that the market doesn't have. So it's the same thing with real estate. Like, are we getting this piece of real estate beneath market value with a strong business plan to force appreciation or develop whatever it is? If you don't have a baked in competitive advantage up front, then why are you investing in it? So that goes across all asset classes. It's the same thing with our new hedge fund. If we didn't have a tested track record coming into this where we have an advantage on the S&P 500, then I would say don't invest in my fund. But I do have that track record going into it and a strategy to land between 20 and 40%, regardless of where the markets are moving, right? So I think that's why, you look at all these different asset classes, like oil and gas is great when oil's going up. Real estate's great when real estate's going up. Hedge fund is really the only place where I can predictably forecast profits, whether the markets are going up and down, because you can trade both sides of it.
Yeah, it totally makes sense. Finding a good fund is important for sure. I think also looking at the fees in the fund and so on, if there's a baked in commission and whatnot, because it can erode your profits, right? So I know that's with more like the institutional funds from the banks where there's a 2% fee in it every year or something, and so you're getting profit, but you're getting substantially less than you could if you had it without different kinds of funding mechanisms that they have in there, right?
Yeah, that one I think is, so that's like, if you're going to invest in public stuff there is no competitive advantage, then you do need to think about the race to the bottom on fees, right? Like, I'm not going to get a mutual fund if I can get the S&P through Vanguard at a 0.03% expense ratio.
Yeah. Well, and that's something I guess, if you're just a retail investor and you go into your bank and they're trying to sell you on some funds there, it's like unless you know how it works, then you can get caught, you know. The more you know is, knowledge is important in this sort of factor, right? And that's why I guess for people that are thinking about getting into investments or getting into a fund like yours, like you got to do your research. You got to take the time to understand how things are working. I remember watching The Big Short and the CDO thing that was going on and all that with the financial crisis and so on, and just explaining how that works to people seems like rocket science almost. How they're bundling mortgages together and selling them off and everything else. The average layman is becoming very complicated now. The investment ideas that are out there, they're so complicated that like it's almost like you have to be an insider to really understand and take advantage of these opportunities, because for the average person out there, they're like, well, I just put my money in the bank and I get interest, right? Or I buy stock and I'll sell it when it's high. Like it's really hard to comprehend sort of some of the vehicles that have been created lately. So what do you recommend for like the average listener, let's say, in terms of getting their education? Where would you go for information that's out there?
I would just read as many books about investing as possible, but really, like, get in rooms, get on meetings, talk to fund managers, understand the space. I think that's kind of the most important thing. But then you really got to figure out your investor identity. I mean, most people should just dollar cost average into the S&P 500, own their home, pay off their primary mortgage, like, and just stay away from private placement, because it's just a very volatile world, and you're going to have outsized returns sometimes, and sometimes you're going to lose money. So you have to be okay with the more risk world means there's potential for more loss, and you will likely make some bad decisions when you're new and learn some expensive lessons. So, that's what I try to do when I meet with people, is figure out, where are they in their investment journey, and really explain to them, like, what I've gone through to get to the acumen that I have now to not make these mistakes. You will lose millions of dollars on the way there, or you can, get it firsthand from people and learn. I don't think there's anything in a book that's going to give you the same value as getting coaching or real world experience from someone who's done it. So, am I cut out for this world? And then how disciplined am I in my in my allocation, right? Like never fall in love with an investment. I fell in love with my own first fund. I put way too much of my own net worth in it because I believed in it so much and I wanted everyone else that was in the fund to know I believed in it. And I ended up losing a bunch of money, uh, because I was just too concentrated, right? So if I had stuck to my discipline of I don't put more than 10% of my net worth in any one deal or in any one sector, any of these things, if you do have some deals that go bad on you, it won't be the end of the world. So I think that's just as important as what investment world you're going to get in is the discipline of how I allocate and rebalance my portfolio overall.
Yeah, the discipline thing I think is important because for people that get sort of caught up in the casino mentality or the poly market mentality, it's like fly by night kind of stuff that they're just throwing money around and it's like, well, this is going to hit big. And it's like the sunken cost fallacy. Everybody put so much money in and, you get sucked into that kind of thing. And I've seen it at the casino with friends, where you go in there and they're losing money all night and they're like, oh, the next bet's going to win it all back for me. Right. But as you said, 10% in one fund sounds reasonable, right? Where you're not risking the farm on one deal. And you were mentioning some mistakes you had made, but that was actually my next topic was, some of the lessons you've learned along the way because you've been in this for a while, right? And you mentioned that one deal that you put a lot of your money into, but what other kind of mistakes have you learned from, or what lessons, best practices have you learned along the way?
Yeah, the one most important lesson that would have saved me millions of dollars is just the third party reporting. I've been in 3 deals now that had fraud in the equation in some different fashion, right? And it happens in weird ways you wouldn't think. When we exited Heartland Foods, I took a large chunk of the exit capital and put it into multifamily real estate syndications because I wanted the depreciation, the capex to get rid of that big tax bill, which worked beautifully. And I looked at, okay, I don't want to put too much capital in one part of the country or in too much A class, B class, C class. So I'm spreading it out. I didn't want to have too much risk with one operator or another. And what ended up happening is one of the biggest, most established billion-dollar plus in transaction syndicators I gave a bunch of money to ended up committing wire fraud to try to save a different deal in the portfolio with capital out of the deal we were in. And that could have never happened if third-party reporting was in place because money can't move unless the fund banking, the general partner, who is the person with the fund, and the third party administrator all have to sign off paperwork for money to move anywhere, right? When distributions are sent out or anything's moving, the administrator works with the bank and the general partner to say, yes, this is compliant before anything can move. So it protects the general partner from making a mistake out of desperation like that. I don't think he's a bad guy, right? It's not something I would ever do under any circumstance, but when people are under immense pressure, they make mistakes, right? And, in his mind, he was like, oh, I'll just take this money over here. I'll fix this property and then I'll wire it back and no one will ever know. Well, that's not what happened. 2022, 2024 was a disaster in multifamily. He got caught with his pants down. And now we've got a whole different problem over here because I'm in a deal that wire fraud was committed in. Again, that third party administrator, most important thing, it's the number one. If you're vetting a fund, that's what I would ask them. Who does your third party reporting? Call them. you know, say, hey, do you administrate for this fund? What can you tell me? What's their track record? Like, don't ask the GP for the track record. Go to the third party admin, call their fund counsel, call the auditor, make sure that all these things are in place. And do you even know what all these things should be in place, for it to be compliant? So these are all the things I learned by getting into some bad deals. And just because somebody's got a 20-year track record and has done billions in transactions doesn't mean that they won't commit fraud.
Yeah. It kind of reminds me of, well, not exactly, but the Exxon Mobil thing where they had Anderson, I think, doing the reporting for them. But Anderson was friends, let's say, in cahoots. So when you have your administrator also part of the inside circle, it can be a problem. But that doesn't happen that often, right?
Nope,
In most
that is
cases.
why no matter how much due diligence you do, no matter how above board things are in the private world, in the public world too, there's always risk. Like that black swan event that you can never see coming could happen. So that's why you never fall in love with an investment. Keep your discipline in terms of allocation. No matter how great something looks or how long it's been performing well, treat it every time you deploy capital in private placement like it could go to zero.
Totally makes sense. Anything else that you can share? These stories are great.
Man, yeah. If you we're wrapping up some heavy litigation and some fraud. that I can't really talk about yet, but it's going to be a movie when we can start talking about some of the things we've been through the past 3 4 years.
Well, it's I mean, the movies are always great to see, like Wolf of Wall Street and so on. All these kind of big movies that have these things, but the impact to people and investors can be pretty harmful, right? Some of the problems that can happen from fraud and so on. It's having people around you that you can invest in, you can trust, and funds that have a track record. I think is really important, and having people that are managing the funds that have a track record that of integrity is even more so, right?
I think the most important thing, if you're talking on track record, is I want to know, like, tell me about a deal that went bad and how you handled it, right? And if somebody tells you, like, oh, I've never had a deal go bad, like I've got a perfect track record, like run the other direction. Like that's just, I don't know anybody that's playing at a high level that hasn't had some deals go bad. So that's how I want to be judged. Like, what's your experience in litigation? Like, if you've never been in a lawsuit, you're probably not playing at a high level, right? If you're not in multiple lawsuits at a given time, you're probably not playing at a high level because people are gonna steal from you. Like, these things are gonna happen. You're gonna have to protect your people when something goes wrong, and you're gonna have to go litigate and make it right and hold people accountable when they're bad actors. So that's the kind of stuff I want to see. Is like, okay, deal went bad. What did you do? Did you just send your investors a K1 and say sorry, write it off, or did you go pursue that capital and try and get it back for them?
Yeah, no, it totally makes sense. I like to say, you're a legitimate business when you have multiple lawsuits happening. It's kind of part and parcel that something is going to go wrong, or you're going to have to defend yourself, or and that's the thing is, contracts are only enforceable with legal, right? A contract only is as strong as enforcement that you're going to do on it. So I totally can relate to that. Maybe you could tell me a little bit about Heartland, right? We've sort of skirted around it a little bit, but that was a $87 million business, right? That you had an exit. Maybe tell us the story of that.
Yeah, it was a great business. It's what I did for over a decade to start my career. I dropped out of college. My dad had that company. It was my dad's a serial entrepreneur. He's built tons of businesses, 7 8 figures multiple times, and this was his startup. So I joined the company, let's say back in like 2005 6, just packing orders in the warehouse, then doing deliveries, all the way into starting in sales, and then eventually building out the whole sales team, marketing infrastructure. And then when the pandemic hit, the company was just exploding. So at the end of it, we were serving the entire Central and Eastern time zone. And private equity came in and gave us a large multiple for what that business would command historically. And when something like that happens, it was never our plan to sell that business, but when you're presented with an opportunity like that, you got to take it. So, yeah, we sold that, and that was very interesting because it was a family business. I'd been working on it with my dad for over a decade, and we were going to keep it in the family forever. And then all of a sudden, it's like, okay, now we're selling it. So, I had been investing heavily as a limited partner at that point in the private placement world, so I had a good understanding of it, and I always wanted to, in the back of my mind, I'm like, this is the world I want to be in. So when I knew we were exiting, I still signed on to the new company. They gave me options and equity in the new business on top of the exit. 4 years, my options vested over. So I planned on staying for a little while, but I started immediately working on the next thing, trying to network my way into the hedge fund world. So yeah, within a year, I was off to the races there. We built a $20 million fund from scratch in 11 months. And I wasn't really happy with the new company and the direction they were taking Heartland in. So I just walked away from it, left my options on the table, and I just went all in on hedge funds, private equity, and real estate.
So, the story you would tell me sort of how, your dad has got the entrepreneurial bug. It seems like you have that as well, because always thinking about the next project, next thing you can build, right?
Yep. Yep.
How did a lot of times we say, it's the environment that sort of molds people into what they're going to be doing, right? If you're surrounded by people that are entrepreneurial and are giving you those ideas and sort of the mindset, and also giving you the learnings as you were growing up. How was that for you? Like, coming up working with your dad. I mean, for some people it's hard, for others it's great. I had a brother-in-law that had a restaurant, and he loved working with his dad. That was his dream. It was his best friend, right? For others it's hard because well, big shoes to fill kind of thing, right? So I guess, how was that whole thing with Heartland, and then was this like a new direction you wanted to go sort of away from the family business with the funds, or are you still working with your dad? I'm not sure.
Yeah, I think over time, I mean, look, there's great times, there's bad times, there's hard times, tough times, and huge, huge wins. Whenever you have partners, right? So yeah, working with my dad was a blessing, and sometimes like we wanted to kill each other too. So
Yeah.
you know, but yeah, he's my original mentor. I learned so much from him. And then it's interesting. Like sometimes he says now, like the student becomes a teacher, and vice versa, vice versa. So now I went into the hedge fund world. Now he had trading companies and he's had firms all the way going back to the 90s in this space as well.
Yeah.
So he's mostly done SMAs, like his own separately managed accounts. Didn't really want to build a fund, but he's an excellent trader. He's got an incredible network of the guys that have retired from Wall Street, from like Morgan Stanley, Goldman Sachs, and they all share research, and we've got quant stuff coming, all this stuff. And I'm just like, look, dude, like you can't keep these returns for yourself. I'm launching a fund around it. Like we're doing it. So now we are launching Alpha Tactical Partners together. He's going to be the head of trading operations. And it'll be just like Heartland Foods. He's going to do what he's great at. I'm going to do it what I'm great at. We know we're great partners in that sense. He's always been the operations technical guy, running the business behind the scenes. And I've always been the sales, marketing, relationship side of building the business. So I'll take care of all the investor relations, facilitate. In this case, I have a lot more fund experience with the compliance side just because I've managed 4 other funds in a different capacity, like working for other people. So I've managed upwards of over $1 billion in pipeline development and real estate and the facilitation of the fund. So I'm taking that experience and plugging that into our new fund. So I'll be that side of it, and he'll be the ops and trading side.
Nice. Well, I mean, it's good that you find a way to work together to your strengths, right? We always say right people, right seat. That's what we say in recruitment. Having the personality for it. If you're going to be the face of the business, you got to have that customer facing personality. You're out there. You're charismatic. You're okay to be on camera. So
Yep.
that's all good. And so you've had all these exits. You've had your career change quite a bit. How do you reinvent yourself as you go through each of these phases, right? From a fund manager to running a business and everything in between. Because after 10 years, I can imagine Heartland must have been a bit hard to leave, right?
It was terrifying. Yeah, when you've only done one thing, and it doesn't matter at a high level that you've done it. I mean, we were in door to door sales, and I remember. I mean, I sold personally $20 million of product door to door, and in our industry, like I have every record still. Like I mean, all records are meant to be broken. We'll see if somebody can do it, but you still have no confidence that that skill set's going to transfer into a new vertical, a new vehicle. I definitely had that sort of panic about my identity and like, could I do this again? You have all these intrusive thoughts. Most successful people don't want to talk about it, but like we're all scared to death. It's just some of us just do it anyways. But what I've learned, especially with building the personal brand, it was the smartest thing I ever did because everything's a people game, right? Like even if you just want a job, everybody goes and like applies on Indeed like everybody else, and they sit there for months and they're like, there's no jobs, no one's hiring. It's like if that's your experience, like your problem is that you're not getting out in the community, you're not going to events, you're not meeting people. Like everything's a people game. So when I started putting myself in rooms that I was intimidated to go in because everybody was more successful than me, all those people are my partners or investors now. So it's like the whole world is there waiting for you, but you got to go get out there and just meet people. It's not rocket science. And people that are more successful than you, like it's intimidating for everyone, but it's like I've never been hated on by somebody more successful than me. They just want to help. So, just don't be afraid to just tell people where you are, and don't ever sugarcoat it. People that are more successful than you and have the acumen, they're going to know anyways. So just own where you are, be authentic, and talk about the intention of, where you want to go, who you want to work for, what you want to create, the value you bring to the table, and you'll find yourself in a beautiful place.
Well, I would equate this to going to the gym, right? There's always someone bigger than you. So you got to feel confident and it's funny too, the same thing. The big guys at the gym are usually the ones that are going to give you the advice and want to help and want to see you come up because, they used to be that small too, right? So that's the analogy I would use. But I guess with the success thing, there's always someone richer, right? So same thing. No, that's interesting. And so how do you combat those intrusive thoughts, right? The imposter syndrome that can happen, the self-doubt of trying a new career or doing a career pivot? Because in our network, we have tons of executives now that have been laid off, thinking of pivoting to becoming a consultant, starting their own business, or finding another W-2 role maybe. And they're having their doubts. So what advice would you give for them?
Just keep moving, like focus on inputs. I think the most important thing is like it's good to have goals and dreams and all these things, but you can't be defined by the outcomes. You can't control them. And I think people are scared to get started. They're scared to, you know, just take frequent action because of the rejection. I mean, in high ticket sales, like if you close at 10 to 20%, you're at the top of the game, which means 8 out of 10 times someone's telling you no. So it's the same thing if you're trying to get a job. Like, okay, 8 people tell you no. What are you going to quit? No, like your yes is right around the corner. So I think the only difference between every degree of success is just the frequency of showing up in despite of whether it's going to work or not, right? How scared you are, so what? You do it anyways. I think the do it anyways thing is literally the difference of whose name you know and who you don't. Like it's the same thing with in our marketing business. All the people that want to build their personal brands are like, well, I'm going to do it when this or when the company's here. It's like you already lost. Like you need to get started when you don't even know why you're doing it so that people can see the journey, right? So I think it's counterintuitive, but it's really just a frequency of action thing.
And what about, obviously you have this big payout, you finish with Heartland, and for a lot of people, they say, "Oh, I can just retire now," right? I mean, some people would, right? Or I don't want to need to work hard again. But fulfillment is not just like financial success, right? How do you find fulfillment with what you're doing?
It's been a big struggle, actually. I think that's the hardest thing for high achieving people is they get wrapped up in their identity and define themselves strictly on their work and their ability to produce in the marketplace. And then time flies by and all of a sudden you're like, I haven't really lived my life. I've just been living for this business, this outcome. So I think that's probably the thing that's changed the most after having a big loss in an investment and having all that hard work you built kind of evaporate. You kind of recalibrate and go, wait a minute, I didn't even get to keep this thing that I worked so hard for. It's like I should have gone on the trip in between. I should have lived a little more. Like my mentality's totally changed on that. It's like, go out to the dinner, take the trip. The business will be okay for a week, Not that there are periods of time that you will have an all-in mentality to get, to move the needle in the business. There are periods of time where you're going to have to do outsized work. But if you go 5+ years and you all you've done is work, I think you're kind of missing the point of life.
Yeah, no, absolutely. What's the point of working if you're living to work and not working to live, right? So I get that. I guess for the fulfillment piece, though, would you say that the journey itself, the struggle itself is fulfilling in the sense of it's not just the outcome, it's everything you're doing along the way that you're fulfilled with? I just say that because for me, building our business, we bootstrapped our business 3 years ago, right? So for us, I find it very fulfilling just building the business slowly, slowly, seeing the increase in everything getting better and better. That to me is fulfilling probably as much as it would be if I sold for, a couple $1 million or something, right? And so is it the journey itself, the struggle? Like I know for me, it's the constant challenges like okay I destroyed this challenge that I had or this goal. Now what's the next one and what's the next one? And that's so there's never an end point. It's more of just the actual process of going through it that can be very fulfilling for people. Do you find it
Yeah,
the same way or?
I do. And I wasn't always like that. So that's been a big shift. And this is the problem with traditional goal setting, right? You don't think that way with traditional goal setting because you're in the I'll be happy when
Yeah.
mentality. Now, like, and I really struggled with this, my first in the Heartland days. It was just never enough. I was always like frustrated for the next level. And then you look back and it's like, okay, well, I've already done all the things I once said were goals that would make me happy. Why am I not happy? And the problem is I wasn't in the process. I wasn't enjoying that part. So the main shift that I made is now I don't have goals beyond 24 hours. I just don't, right? It's like, okay, what are my next 24-hour goals that I can win the day? And now I'm in the day in the process. It's the only way I've been able to find like how to enjoy the process every day and not, future cast and think about the big targets that are overwhelming. So now it's big dreams, right? I say this on every podcast. Your potential ends at the distance you can dream. So dream huge. but don't be obsessed with the dream on a daily basis. Be obsessed with what you do to operate in that 24 hours that moves the needle forward a little bit.
Yeah, small wins, sometimes it can be as simple as, did I make my bed today? That's a win that I did it as soon as I woke up and had my morning jog or something, or I ate well today. That was a win, right? So small things sort of build to bigger wins. I totally get that because otherwise you get sort of like caught in the shadow of this huge goal you've got for yourself, right? It's a huge shadow over you, and it that's where the doubt can come in. It's like, oh, we're off goal. Oh no, right? Instead of, well, what can I do today to move the needle to the goal, and the small little micro wins we can do along the day to make us feel better, with ourselves too. So I get that. So with your business now, you also started helping people with social media and building their personal brand. How's that going?
It's great. I mean, I think I'm passionate about it at a really high level just because it's what opened up all the doors for me. If I hadn't built my personal brand, I wouldn't be doing anything that I'm doing. I wouldn't have any of the partners that I have. None of this would be here without it. So I like specifically, social media has become such a fake world. People green screening, renting jets and yachts and like making
It's
content with
ridiculous.
it. It's been so tired out now. I think like it's kind of going away, which is great. But I like working with people who are doing something incredible in the real world, more old school business type people, and they're being completely underserved online. So they might have a small presence, but it doesn't match the player they are in the real world. So I try to accelerate that.
So what would you say are best practices for someone that's, thinking about building their personal brand right now? Like, do you have to be on every platform, or is it TikTok? Is it Instagram, or what's the consensus right now? Because I just say that because on LinkedIn, since January, they changed the algorithm, the impressions, the visibility of posts, it seems like everything's been monetized now. It's very hard to get any kind of traction on LinkedIn from what it used to be, you know? And so it's like one change of the algorithm, and that platform could be almost dead to you, right? Or something else can happen with like X and Twitter being bought out, and that caused some issues. Like, so do you say have multiple platforms at work, or what would you say is best practice for that? Okay. Yeah, you're right about the ad spending. It's gotten pretty aggressive, let's say, with how much people are pumping into socials and so on. And now I see also Reddit sort of a whole new, it's a greenfield kind of operation on Reddit, because it seems like that's going to be the new frontier for a lot of stuff going on as well. Have you guys started using it, or? Yeah, it's well, between that and also advertisement on AI, right? Like they're going to be having paid advertisements on ChatGPT. I think there's trials of that going on right now. I think the minimum is 150,000 a month or something to be on there, but eventually it'll be available for retail business, right? To use AI as another form of, traffic, let's say, to your site or your products, right? So everyone's competing for this ad dollar spend, and I guess social's still one of the strongest, right? Yeah, building authority with like authoritative websites like Forbes is important. It's costly, but it can yield benefits, right? With the backlinks to the site. That's what you're talking about. I get that. So for yourself, I mean, you're getting involved in let's say social media and helping build personal brands. You're involved in the funds. Is there anything next that you've planned? Or is your next step, or are you going to be riding this for a while? Nice, nice. Well, we'll definitely share all the links in the show notes for how people can get a hold of you, and looking forward to your fund. As you said, 15 days, right? That's when it's going to be officially launched. Yeah. And when you said 3 years of track record, what kind of returns are you sort of? What would be the ideal to have a good track record in your mind? Well, God forbid you overperform, right? But no, that makes sense from a risk strategy, and from people like looking at it from outside. If it looks, as he said, too good to be true, then they're going to think it's a scam. I guess that's sort of the mentality of it's you're doing too well. But wish you the best of luck with the launch, and something we'll keep an eye on for sure. Really appreciate having you on the call today as well. Yeah, thanks.